Price action like this is where you're going to lose the most amount of money, blow the most number of accounts, and overall just have the most difficulty trying to trade it. Now, most people are very good at complaining when they try to trade bad price action where they blew all of their accounts. However, these same people don't know how to be proactive and do the bare minimum when it comes to anticipating when market conditions and price action is going to be subpar. So these people will try to trade every single day where they have no idea what's coming, and in most cases they get caught off guard and they try to force trades during bad conditions. So in this video, I'm going to tell you the simplest and the easiest ways to anticipate if the price action for the day is going to be bad, and if you're going to be better off for the day just going outside and touching grass. Now, when it comes to trying to predict if price action is going to be good or bad, you need to look at a few different things. As we all know, the market does not like uncertainty. Now, what are the main things that cause uncertainty in the markets? Earnings reports, news, especially about inflation or interest rates, war, or any other political events coming up, as well as bank holidays. So the first thing that I do every single week before I take a single trade is I go on Twitter, and then I go to this account called Earnings Whispers. Basically what they do is every single week they give you a calendar view of all the earnings that are coming up. Now, this is the easiest way by far to anticipate if price action is going to be good or bad. For example, this week on Thursday after the close, we have Broadcom or AVGO earnings. If you are not familiar, they make up over 5% of the QQQ index. So what that means is that their earnings report is going to matter and you should pay attention to it. Now, in most cases, these major companies, their earnings are always after the close. So that generally means that the price action for that day will be more difficult or choppier because of the uncertainty that this earnings report entails. Some other names that you should pay attention for their earnings are any of the Mag 7 names. So Nvidia, Microsoft, Amazon, Apple, Google, basically any of the major tech companies you should always pay attention to because they make up such a big percentage of the QQQ and S&P indexes. Those are basically all the names that I pay attention to personally. So first up on the checklist, go to Earnings Whisper on Twitter and make sure that this upcoming week does not have any major earnings reports coming up. Number two, easiest way to avoid price action or anticipating when conditions are going to be bad. I go on this site called forexfactory.com and then type in /calendar at the end. Now, what this website does is it gives you all of the upcoming news events. So not earnings, but it gives you all the important news events that are coming up for the week ahead. Now, once you get to this page, this will include all of the events. So yellow to red folder. Yellow is like the least important and red is the most important. I mainly just pay attention to the orange and red folder news events coming up. To filter that out, just click on this button above. Clean this up so that you don't have 40 different things to look at every single day. Just click on this filter button in the top right, and then I uncheck the yellow folder and I make sure that only the USD currency is selected right here. Then click apply filter. Then it will only show you the orange and red folders for the week ahead. These are the ones that you need to pay attention to the most. So tomorrow, for example, we have both a red and orange folder event at 10 a.m. Eastern. So that is 30 minutes after the New York Open, which means that I most likely will not be in a position until after that event is done. Same thing for Wednesday. We have Jolts, which is at 10 a.m. Eastern. Unless something really A+ sets up before the news comes out, I'm not going to take it. In my opinion and in my own experience, it's always better to wait for the news to come out before you look to enter a position. Another way you can use this information to prepare yourself better for the week ahead is look for these events: FOMC, CPI, PPI, or non-farm payroll, or NFP. So non-farm payroll is announced on the first Friday of every single month. This used to be called non-farm payroll. I'm not sure why they changed it, but like I said, FOMC, CPI, PPI, NFP, or non-farm employment. Those are the most important red folder news events of every single month. So what that means, and more importantly, how you can use that information to prepare yourself better is, for example, say that NFP or CPI or FOMC is the next day. Generally, I would expect the price action of the day before these big events to be subpar, especially FOMC because those are always at 2 p.m. Eastern on Wednesdays. So I would expect the Tuesday, so the day before, as well as the entire day on FOMC day to be higher risk and lower reward. Now, if you've been doing this long enough, like myself, you would have your own experiences as well as you hear other people's experiences on how many accounts they've blown on FOMC day or the day before CPI or PPI or NFP, which means that generally you would be better off avoiding trading on those days. Now, the next way to easily avoid bad price action is to know when the bank holidays are. So I primarily day trade futures, which means that even if the New York Stock Exchange is closed, the futures market is almost always open on most holidays. For example, today is Labor Day, which is on this list, Monday, September 1st. The New York Stock Exchange was closed, but the futures market was open till about 1 p.m. Eastern. This means that the amount of trading volume that is in the futures market is going to be exponentially lower than a typical day. So what does it mean when the trading volume is much lower than typical days? It means there is a much higher likelihood that there's going to be more choppy price action and a lot more consolidation than your average trading day, which is exactly what we saw today. After a initial 30-point sell-off right off the open, we basically stayed within a 20-point range on NQ, which, if you're not familiar, that is an extremely tight range, especially for the New York session. So days like today, I imagine that there are a ton of people who try to force their setups and keep taking trades over and over and over again until they ended up blowing their accounts. I personally did not take anything just because, like I said, from my own personal experience, days like today are generally not worth trading. So like I said, it's super easy to avoid days like this and not be like most people when it comes to being caught off guard and just overall preparing yourself better for the conditions ahead. I'll include all the links that I use in this video in the description below, but this one is nysc.com/markets/hours calendars. Super simple way to avoid getting caught off guard and being like most people. That was tip number 3 on how to not get mollywopped and prepare yourself. Now, last but not least, the easiest way to avoid getting caught in bad price action is marking out the opening ranges of the New York session. So on most days, I don't take a position until the first 30 minutes of the New York session is set. What does that mean? So first I go up on the 15-minute chart, and then I wait for the high and low of the first 30 minutes once the New York session opens. Once that first 30 minutes is up, I will mark out the high and the low. Once again, this is on the 15-minute chart, as you can see up here. Now, once that range is marked up, I'm going to be looking for a couple things. So generally, I will not take a position until at the very least the first 15-minute or the first 30-minute range of the New York Open is set. Now, obviously, not every single day is going to play out perfectly with these opening range breakouts, but the more you pay attention to the price action right off the open, you can start to get a much better feel for if it is even worth trading or not for that day. Some people use the 5 minutes, some people use the 30 or even the 1 hour opening range to decide if it's worth trading for themselves or not. I think it's good to keep all of those in mind. For example, in this case, the opening range high for the first 30 minutes of this day on August 25th, the high was 23,741 and the low was at 576. So almost a 200-point range within the first 30 minutes of the New York Open, right? Now, were there a lot of opportunities to trade within this range on this day? Of course, but the concept is the same and it is very simple. All you do is mark out the high and the low of that range from the first 5 minutes or 15 minutes or 30 minutes, whatever you like. And then basically you wait for a break out of that range and then retest back into it. And then you go long or short depending on the direction. So in a perfect world, say that the opening range for the first 30 minutes looks like this. All you'd be looking for is a break either above or below that range. So say we break below, retest back into that low of the range, and then that's where you would be looking for a short entry for some continuation to the downside. Same exact thing to the opposite direction. So say we are bouncing around in this range in the first 30 minutes, we get a break above it, look for a retest of that high of the previous range, look for a long entry there, and then get continuation to the upside. Like I said, obviously this is not going to play out perfectly every single day. There'll be times where you get that initial breakout and then you get sucked back into that range and then just chop around in there the rest of the day. But in terms of getting a higher probability entry compared to just hoping that there is continuation in either direction, this is one of the tools that I use personally that has helped me not get caught in this garbage price action that we all hate. But like I was saying earlier, people are very good at complaining about quote unquote bad price action, but most of these people do not even try to avoid it or be proactive in their planning for the week ahead. So in my experience and in my own opinion, the easiest ways by far to not be like one of these people is just do the bare minimum. Pay attention to upcoming news, upcoming earnings, upcoming holidays, as well as watch the opening range and the price action within it. Just do those, just pay attention to those 4 very easy things, and I promise you, you will save a lot more of your accounts and you will lose a lot less money. But I hope that helps. I'll see you in the next one. Take care.